There are a million unknowns in the market right now. Fortunately, we have Hillary Kramer, Chief Investment Officer of Kramer Capital Research, to break it all down for us. Thanks for being here, Hillary.
Pleasure.
So if we had a worst case scenario, 10 to 25% tariffs, is that not all priced in right now, at least the S&P 500?
Well, it really depends on how hard hitting that $300 billion really is in terms of those tariffs, because we always have exceptions, and there's always a way to carve out on that. And certainly, I don't really see it actually happening. We really aren't going to see the tariffs slapped on.
There are tariffs in place. They've been in place for about a year, over a year if you go back to March 2018. What makes you say that you don't see that additional tariff happening?
Because the tariffs, as we saw this time around, especially because of the Chinese reaction by letting their yuan go above 7 for the first time, and we saw how the market reacted to that with that awful Monday that was kind of reminiscent of last Christmas when we had that awful Christmas present of the market down. It's too much really to take, and the Federal Reserve will counteract anything potentially that would happen, and $300 billion always gets carved out and carved up, and in the scope of all of GDP, it's not really as material and relevant as people realize.
So yeah, one of my next questions was, even if it's not fully 25% on all $300 billion worth of goods, it's still not a good thing for the U.S. economy. It's not a good thing for stocks. If you get a Fed saying, okay, now we're going to cut again 25, hope maybe it is 50 basis points, what would the net effect be on stocks in your mind?
The net effect is that the stock market will still do what it's going to do because, Jacob, you're right, it is built in. It is built into the market, the whole concept of the tariffs. But what's also built in now is that we may not have an agreement ultimately. I mean, the tariffs and slapping on, these extra percentages, whether it's 10% or 25%, it's all in reaction to not having a deal. So kind of the bigger question on tariffs is, are we going to have a negotiation, an agreement by December 31, 2019? And what the market is really reacting to, and would react to in a much greater way, is if it turns out that the Chinese don't really come to the table until after the election, and if they've really decided, hey, let's see who gets in office, and then we're going to come to the table after we see whether or not it's President Trump or not. It's just gotten very personal.
Okay, so now when you look at companies, aside from tariffs, when you look at companies that maybe are less economically sensitive, or you look at companies that can mitigate tariffs really well, or whether it's small caps that are insulated a little bit more, real quick, what are some of your favorite sectors right now?
Banking, the big international banks like Goldman Sachs that have everything from private equity to entree into even individual banking, M&A, the capital markets. They can do the cross-border global deals, because now you have so many of the players from Europe who are essentially out of the game. Whether it be Deutsche Bank or HSBC, Goldman Sachs is really filling the void.
So fair to say you're looking for diversification and agility in a company?
A company that can really work itself outside of our borders, but be insulated to a great extent from interest rates and continue to have revenue streams from all different angles. Of course, you also have banks like JP Morgan. I'm always looking at the credit quality. I'm always looking to see how that's looking. And there are no cracks yet in a place like JP Morgan. And certainly they've gotten, kind of bigger and stronger. And for all we know, one day they'll put out their own cryptocurrency.
Thanks for being here.